most successful people in the world, the people like Bill Gates and the Musks and the Buffetts, all have entire teams of tax professionals that have been advising them about what to do with the money that their businesses make. And I want to give you 6 ways that the super successful end up paying a lot less in taxes. The first is they're self-employed. They take advantage of the associated tax deductions that come along with that. You need to be considering ways that you can get involved with self-employment and the tax perks. Now, this is not going out and quitting your day job so that you can start your own business. Yes, the time should come eventually where that is possible, and that should be what you work toward. But in the meantime, keep your day job and rely on self-employment to gain tax benefits. You could stock an entire library with books on how to leverage the value of filing your taxes as a self-employed earner. And literally every dollar that's spent on the business itself, everything from wood screws to insurance premiums, have a category as a deductible expense come tax time. So the result is a reduced tax liability that simply can't be found anywhere else. The second way to reduce your taxes like super successful people is not selling all of your appreciated stock. They will oftentimes donate a portion to charity. In fact, philanthropy in general is very important. Giving back with the fruits of your labor is an incredibly satisfying part of living life as a highly successful person. When appreciated stock is used as a donation to qualified charities, 2 things are going to happen. The donation itself is viewed as a tax deduction, and then the seller of the stock doesn't pay a dime in capital gains taxes for the investment. So it's really a win-win situation. Now, the third way that I want you to be able to keep as much of your money is being able to write off fabulous health insurance premiums is going to be a really great advantage. The key to really stretching this deduction as far as possible is to claim your health insurance premiums as a business expense used to run your company. By doing this, the post-tax cost of your insurance could very well even make better coverage more affordable for you. Number 4, using depreciation as a tool is also a really fabulous way of preventing more taxes. Anytime a business loses money as a result of asset depreciation, a tax deduction can apply. And a lot of business assets, both tangible and intangible, are going to depreciate in value over time. These assets can include software, can include computers, can include different machinery, it can include big vehicles. Big time depreciation can even sometimes be used to reduce tax liability for multiple years. The 5th way of preventing more taxes is using the most tax-friendly long-term investment vehicles. When tax-free investment growth combines with tax-free income at retirement age, you win big. Those who've grown their wealth enough to max out traditional long-term retirement investments like 401ks move into options like the rich person Roth, a highly powerful way to fund later life without paying a dime in taxes, potentially. The 6th and final way is that successful people pay way less in taxes by optimizing their retirement earnings. And using the money that you'll have in retirement as a method to pay less taxes today is considered to a lot of people to be a brilliant method to reducing your overall tax liabilities. And I think for most people that is true. Self-employed individuals or those who own small businesses can claim themselves as both the employer as well as the employee. And it gives us a much higher investment cap for things like 401ks. So the key is starting to learn enough to get started, get out there saving more money on your taxes each and every year. While I do support and subscribe to a number of these philosophies in order to maintain a proper tax strategy, there are 2 things I do want to counter with on these popular points. Number 1, paying far less taxes, and in some cases paying as close to 0 or even no tax at all, can come back to bite you when you're in the process of pursuing accessing new debt weapon accounts. When you're out there looking for new loans, the lenders, aka banks, are going to want to see that you can have a debt to income ratio that falls well within their maximums in order to qualify for things like mortgages or non-mortgage related loans. So going out and trying to spend as little as possible on taxes may not be the best decision, while simply going out and managing your taxes on a much more proactive strategic level so that you pay just enough in taxes is much, much better. The second thing I want to add to this is traditional retirement accounts have by and large been ineffective for wealth creation for someone like me. I can actually find alternatives to those whereby even with tax liabilities included, we can have such a difference in returns that it makes it worth it for us to actually see some of the tax consequences that come with alternatives to the traditional retirement accounts. Most of that has happened in the way of entrepreneurial opportunities. So the best returns on investment I've ever seen have been growing and investing in businesses. If that's not something that you're comfortable looking into, becoming self-employed in order to get tax gains as well as using traditional retirement accounts might be a much better fit for you. Guys, thank you again so much for tuning into the channel. Make sure you stay tuned to the other videos here on the channel. Become a subscriber, drop a like on this video if you want us to continue to dig into these various topics to maximize your financial picture. Until the next one, make it a great day today and take care.